Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me typically would be the Governor of Real Estate of the great state of Texas, Mr. Michael Becker, but he is on another due diligence assignment. So in the podcast today, the professor himself, Mr. James Eng. James, how are you?
Good. My voice is a little bit better after Vegas.
You shook a lot of hands and you talked your lips off. And so you were very busy seeing 10,000 of our favorite apartment investors at the National Multifamily Housing Council meeting in Las Vegas. That I think we had some great response from your podcast. James, just kind of talk a little bit about some of the themes that happened out there.
Yeah, I mean, I think it's everybody's pretty positive. Everybody sort of first half of the year, nobody's really feeling any pain quite yet. So it's hard to get people who bought on a 4 cap to sell at a 6 cap, 9 months later. And so we're going through sort of that process of figuring out where people want to buy, where they want to sell. And I think today's podcast is going to be super informative for people who we coined the phrase, or we stole the phrase, survive to 25. A lot of people are trying to figure out what to do with these bridge loans sort of that they put on in 21 and 22. And so that's what today's conversation is going to be all about.
Sounds great. So, and one thing more, can you tell us when JP Conklin is coming to Dallas and going to sit in front, stand in front, talk in front of 300 or 400 of our investors? When is that going to be?
Yeah, so you go to oldcapitalpodcast.com, you can register for the event. We probably have about 250 people already registered for JP. So Wednesday, March 22nd here in DFW, and that'll be live in Grapevine. And then we also have our bowling tournament coming up, Strikeout Homelessness, on April 6th. So we have a couple more teams available for people to perform or bowl. And so if you have not signed up for that, that's also April 6th.
After breaking my wrist last year in basketball, we were changing sports this year. So we're excited about that. All right, let's get into the podcast. So our theme last week really was about protection. We spoke with fellow apartment syndicator Lane Bean about protection. As you remember, Lane played football for the Air Force Academy, and he had 10 other guys or teammates around him to protect Lane and win the game. When Lane graduated and started his career as a fighter pilot at F-16s, he had a team around him. The aircraft maintainers, the refuelers, the avionics people, the weapons people. His team of guys and gals protected Lane. He felt secure when he flew his fighter aircraft over enemy territory. He knew he could count on his team. Today, Lane is a GP in apartment syndications, and as a syndicator, he finds the opportunity to buy apartments and finds investors and their money. He is a leader that brings those two groups together. The team buys the real estate and must count on the GP to lead. But today, with rising interest rates and a flux in the apartment market, the team must be protected. Nobody wants to lose money. The roles are now reversed. The GP must protect the team. Lane must protect his team. It's the GP's vision and action that must protect his or her squad, crew, team, or better known as his investors. Today, with lots of bridge loan issues, the GP will be faced with choices to protect the investor. Most investors cannot sell their properties today with higher interest rates, higher cap rates, rental rates not going up at the original pro forma number, interest rate caps that are coming due for renewal. So what do you do? 1, raise more money with capital calls for the current limited partners. 2, if the limited partners are not there or don't decide not to put any more money into the deal, they must find private equity to come to the table. 3, sell the property. If it was going to be sold today, if you just bought it a year and a half ago or two, it's going to be a probable loss. 4, refinance the Fannie Mae Freddie Mac loan and with the possible cash in, and we'll talk a little bit about that. Or 5, refinance with HUD and change the narrative. Change the narrative into a longer term hold and protect the investors. So we're going to talk and chat about HUD loans today. So in the podcast, we have two of our friends, and I'm going to call them Mr. W and Mike. And Mr. W, thanks for being on the show.
Thanks for having us, bro. I always love being a part of it.
And Mike, how are you?
I'm doing great. Very happy to be here. I appreciate the invitation.
So Mike, tell me a little bit about what you do, what's your title, so people can get a better understanding about what your job responsibility is.
Absolutely. So I'm the Chief Operating Officer of a nationwide FHA platform, in charge of running day-to-day on our FHA portfolio and our FHA platform. So we, over the last several years, we've averaged around $1 billion of originations on the FHA side. 2022 was down a little bit, based on some of the interest rate movement, but we're a nationwide player that works with all HUD offices around the country. We originate loans under all of HUD's programs, the 221D4, which is new construction and sub-rehab, 223F, which finances refinances and acquisitions, are the primary programs we use. HUD also has programs for senior housing, like assisted living, memory care, skilled nursing, as well as senior cooperatives. So experience throughout the country and work with all of the HUD offices to ensure that our borrowers' loans obtain firm commitments, lock advantageous interest rates, and get to closing. I have a team of processors and a team of intake analysts as well to make sure that when opportunities come in, we're turning those around and helping explain the options to our client.
All right, we're going to break this down into pieces. So I'm going to throw it over to James. He'll be the Grand Inquisitor, and I'll just add some additional color. So James, let's get going.
Yeah, I mean, I think most people who listen to this podcast are familiar with Fannie Mae, Freddie Mac. They can close a deal in maybe 45, 60 days. It's non-recourse, fixed rate, 10-year term, 3 to 5 years IO, and then 30-year AM. And then you'll have some sort of prepayment penalty, whether it's yield maintenance or step down. And so I think, most people are familiar with that. And, the past couple of years, people have sort of moved over to the bridge side a little bit more on sort of shorter term, let's say 3 to 5 year money. And so a lot of those people, let's say you bought a deal in 21 and you put a bridge loan, let's say $20 million. And now you're coming up upon either an interest rate cap or a maturity on the initial term. And you come to us and we say, all right, well, you put a $20 million loan. Fannie and Freddie right now, they might be at $17, $18 million on a 5.5% interest rate. And so a lot of people are like, well, I can't go back to my limited partners. I need a little bit of help. And this help, our second option behind Fannie and Freddie is HUD. And so we're going to talk about the 223F program, but I also want to talk about the 221D4 construction program, because I know there's a lot of people who see that as an option as well, especially right now. Every time the Fed raises their rate, banks are raising rates. So, a lot of bank loans right now are in the 7.5%, 8.5% range. And so I want to spend some time talking about 221D4 and then flip over to 223F and talk about the refi piece of it. So I think Mr. W, maybe start off with 221D4.
Sure. No, the 221D4 program, the benefits are primarily non-recourse, 40-year amortization, 3-year general construction term, and it's a construction to perm loan. So you're able to rate lock, at the close of the construction loan, then it's locked. There's no takeout at the end of the construction period. And so, as you mentioned, it's super competitive at the moment, given where banks are in terms of leverage. So if you're trying to get a bank loan, you're probably in the 60% LTV, 65 max. Or on HUD, you can go up on a market rate project up to 85% of cost. And obviously, this loan prices off of the 10-year treasury, which as in 22 kind of was the first one to go up. But now as we get into 23, that's the first one to go down. And so it's pricing a lot more competitively than bank loans are currently.
All right. So fully amortizing, you said 40 years. And then, so a lot of people who, in 2021, a lot of people were looking at new construction just because value add deals got pretty expensive. And so they were looking at construction, and most of those people took floating rate construction loans. And a lot of those loans are number one, recourse, number two, lower leverage, and number three, they have a maturity, typically 3 years. So they give you 3 years to build it, and now you got to refi us out. And so a lot of people are looking at, all right, well, I built it. I'm leasing it up, but when I'm going to refi to Fannie and Freddie, the proceeds just aren't there. And so I guess before we jump into the refi piece, talk about some of the other parts of that loan on the 221D4. Either Mr. W or Mike, you can take this one. What are some of the differences between the HUD piece compared to just a normal Fannie Freddie loan?
Sure. Well, I can jump in on that one, James. So the HUD piece, as Mr. W mentioned, is a construction loan that converts to a permanent. So significant benefit is taking that interest rate risk out during construction. The loan does start amortizing a few months after your construction period ends. And so we build in escrows to help account for covering debt service while your property is leasing up to make sure that that's accounted for. But comparing the structure to, say, a Fannie or Freddie loan, the HUD loans are executed with a 10-year prepayment penalty period rather than a yield maintenance. And so for the first 10 years, you'll have likely a step-down prepayment structure where in year one, it will be 10% of UPB. In year two, it'll be 9%, and so on until open at par in year 11. And the benefit there is that you have a predictable prepayment penalty structure as opposed to a yield maintenance that's dependent on market conditions and duration. So it's very predictable from that standpoint. HUD loans are also fully assumable, and HUD does not charge a fee for that assumption. So really, it's a matter of just covering legal costs and a submission into HUD. So that's a benefit for an owner as well if there is an opportunity to sell that property in the first 10 years. 221D4, I'll just touch on, James, before we talk about the refinance. HUD will, so the construction period is interest only with a drawdown. We capitalize that interest during the construction period as a mortgage eligible cost. So that's built into the budget. A couple things to note is that HUD does require the payment of Davis-Bacon wage rates, which depending on the market, sometimes that's higher, sometimes that's already priced in based on the contractor you're using, but something to consider as you're looking at that loan program. But really what's important to note on the construction piece is that HUD's mission and really the goal of its programs is to provide liquidity into the marketplace and provide housing. So if you're in a market where maybe banks are pulling back or being more cautious, HUD is going to be there to lend. If there's a market and there's demand for a project, HUD will step in and provide that liquidity and provide that mortgage insurance on that loan.
Now, Mike, also too, that these new construction properties, they don't have to be just affordable or like Section 8. Some people always think about HUD as just Section 8 type of stuff. But these can be market rate, Class A buildings, something that's just absolutely gorgeous and beautiful that you can get full market rates at. Is that correct?
That's absolutely correct. And while the program is great and one of the best executions for a low-income housing tax credit or a Section 8 property, a lot of what HUD is financing is market rate apartments because there is very much a need for market rate housing, both in urban areas and in suburban areas. So HUD is financing a lot of market rate. And one of the things that incentivizes that as well is HUD has what's called a green MIP. So you can get a reduction of your mortgage insurance premium, which is what funds essentially the guarantee that HUD provides through Ginnie Mae. If you have a market rate property and build to a third-party green standard, you can reduce that mortgage insurance down to the rate that HUD charges for an affordable project. So a significant benefit as well for what a lot of apartment developers are already doing, either based on building code or because they're wanting to build a green project.
Let's just give an example. Like if you were to build, let's say, a $25 million project, that would be the construction cost, and you could go up to 85% of the construction pieces. Is that correct?
Yep. So HUD will finance up to 85% of what is considered HUD eligible cost, which is all of your hard costs, pretty much all of your soft costs, excluding a developer fee. The only things that really aren't mortgage eligible are those reserves that I talked about. So a working capital escrow to help with lease up and an operating deficit escrow to help account for debt service. So really the loans end up being about 80 to 83% of total development costs. Paul, also one thing that HUD will give you credit for equity in the land. They don't require, a hard cash equity contribution like a commercial bank might. And HUD also, in the event that you have a cost limited mortgage and you have an identity of interest, HUD calls it, which means a general contractor or its principals have any ownership stake in the project, you're able to boost that borrowing basis as well through something called BISPRO, which I won't get into in significant detail, but that helps boost the leverage on cost limited loans as well.
So today we're in the beginning of February or so. What would, if you were to lock the loan in, but again, you don't lock these loans in until the loan is up, committed or approved, what would be interest rates on a HUD loan right now, as an example?
If we were to lock a HUD loan today, the rate would be in the 550 to 560 range prior to MIP. So that's your note rate during the construction period, and then for the 40-year fully amortizing term after construction.
Now that's amazing because rates today, construction loans are probably about 8%, 7.75% to 8% on something like that. And you have to put down 35 or 40%. Now that's the benefit of having a HUD. Now, talk a little bit about the negatives of having a HUD loan, and then we'll jump over to the refinance because that's really the topic of the conversation.
Sure, and I think your segue for what would the rate be if we lock today is a perfect transition because HUD does have a slightly longer process, and that's something that I think is important to note about the 221D4 is that it is about a 9+ month process, and I say 9+ because it really depends on the, where your plans and specs are when we start a transaction and what the timeline of the architect is. HUD does require a full set of plans and specs, including your structural, your civil, and your MIP, which means that HUD doesn't allow a typical design build. And HUD also requires those plans and specs to be reviewed by a third party, as well as a full construction bid for the application. And so, we do see the HUD 221D4 process take, I think at a minimum, probably 9-ish months. I think an average is probably 9 to 12. Most projects, the timeline is driven by the overall design timeline. So depending on, if you're using a HUD experienced architect or how busy your architect is, that often drives the timing. But the timeline, I think, is the most important thing to consider. Paul, I mentioned Davis-Bacon wage rates, depending on what market you're in. That's something that some might see as a drawback. And then additionally, on an ongoing basis, if your listeners are used to a Fannie or Freddie loan, they're used to submitting quarterly financial statements to the lender, but they're not used to getting an annual audit. And HUD does require an annual audited financial statement to be submitted. HUD does allow monthly distributions from surplus cash flow to be trued up with the audit at the end of the year. To qualify for monthly distributions, if you're new to the HUD programs, you do have to have one successful first year with your operations, no issues with HUD. And during that first year, you can distribute semi-annually. So once at the end of the year with the annual audit, and then in the middle of the year with a calculation from your auditor. But the monthly distributions are a big change and improvement in the program.
All right. So the way that a lot of transactions get done on the construction side to build new apartments is through HUD. Contact Old Capital on that to get further information. All right. What we're here for really is the protection of the limited partners and kind of talk about different ways of structuring possible HUD loans to have it as ability to kind of survive to 25. So James, give me an example or so why somebody would consider doing, again, a HUD loan today for a refinance.
Yeah. I mean, if let's say you did a bridge loan either in 21 or 22 for $20 million and, you've come in, done your plan, done your value add, raised the rents, improved the NOI, and now you come to us and say, hey, I want to get out of this bridge, maturities in the next 12 months, or the interest rate cap is expiring, and I want to move to a longer term, fixed rate or floating rate. And Fannie Mae, Freddie Mac, we size it up and we get to 17 million. So we're 3 million short. And you look at your limited partners and you say, hey guys, we need $3 million. And you go around the room or send out an email, do the webinar, and the $3 million doesn't show up. And you as a general partner have to put the money in, or you're going to have to do something, or you're going to have to sell the asset. And right now might not be the best time to sell the asset. And so what people are looking for is another option. And so the 223F is the other option. They're going to size it a little differently, lower debt service coverage, and potentially longer amortization. So I'll swing it over to Mr. W. How are you guys sizing 223Fs, and what should people be aware of on those refis?
Yeah, I think you hit a couple of them on the head in terms of the lower debt service coverage. So being able to go down to a 118 debt service coverage versus a 125, and then a 35-year AM as well. HUD traditionally underwrites based on a trailing 12 month, especially on a refinance. And so it's similar underwriting to a Fannie and Freddie loan in terms of, how you're getting to an NOI. But you do get 35-year AM consistently, where on the Fannie and Freddie side, you really got to have some sort of mission richness to qualify for that 35-year AM on the Fannie Freddie side. So we've seen a lot of success. I would say the biggest delta between sizings that we've seen recently between Fannie and Freddie and HUD are on Class A assets where you don't have any mission richness. And so you're going to have to be at a 30-year AM on the Fannie and Freddie side, where you're getting to a 35-year AM and a 118 debt service coverage on the HUD side.
All right. And then this is going to be fixed rate with a step down prepay. Is that right?
Correct,
and then
correct.
How much, including maybe touch on mortgage insurance premium also, and then, adding that in, if Fannie and Freddie are 5.5 today, all in, what would a HUD loan on a 223F look like right now?
So the all-in note rate today on a HUD 223F would be right around 5% plus MIP. So the MIP, it's mortgage insurance premium. I know Mike touched on it a little bit earlier. That's what funds the basically the guarantee for Ginnie Mae. But if you don't do green, or if you do green, it's 25 basis points or highly affordable at, or if you are not green and just standard market rate, you're at 60 or 65 basis points. And so that you do need to add that on to the total rate. So if you're able to do green, you are inside of where agency rates are today.
Okay, so do green, inside agency, and then plus that extra 118 debt service coverage comes into play. And, a lot of people, they're used to maybe a 45, 60-day close, and then also locking the rate or index sort of, within 3 weeks. Mm-hmm. Talk about the process on the 223Fs, and then especially around the rate lock.
Sure. So the process today on the 223Fs are anywhere between, say, 4 to 6 months in terms from start to finish. Where like you mentioned, the Fannie and Freddie stuff is traditionally about 45, 60 days. That's, on the HUD side, that's a significant improvement, 4 to 6 months. We're in, 21 and beginning of 22, it was taking 12 to 14 months even to process these 223F, just because their queues got so long. And there was a lot of demand and they didn't have the support staff to keep up. But now that's all cleared out, and most HUD offices do not have queues. So it's right around 4 to 6 months. And so say it takes 4 months to get a commitment, hypothetically 3 to 4 months to get a commitment. You rate lock quickly after you get the commitment and close about 45 business days after you rate lock. Mike, anything to add?
Yeah.
No, I think that's about right. And the biggest thing is, if you've heard horror stories about a HUD loan or a HUD refinance over the last several years, it is important to emphasize what Mr. W said, that the queues are gone in all HUD offices. So HUD has 45 days to process an application once we submit it to them. And the queues were delays in putting those applications into processing. So those applications are getting assigned to underwriters right away. So as quickly as a lender can get engaged and get their third-party reports, which is an appraisal, a capital needs assessment, and a phase 1 environmental, as well as the application due diligence, the lender can submit that to HUD and expect a commitment in 45 days. And at that point, we can lock in that interest rate and move toward closing.
All right. So I guess the other thing to talk about is, I think most people are thinking, all right, 221D4, that's new stuff. And then 223F, we haven't seen that on a ton of, let's say, B and C stuff, but more on A stuff. And talk about why mostly A stuff goes through the process and maybe not a B and C deal right now.
Sure. So HUD works for all sorts of asset types, right? And we do see some B and C loans, but candidly not as many. And I think that's for two reasons. Number one, HUD currently doesn't, and on the affordability side, HUD doesn't look at mission richness the same way Fannie and Freddie do. Their incentives for affordable are big A affordable. So restrictions that are very similar to the Section 42 tax credit program. So properties that are just naturally affordable or workforce don't currently get any incentives through HUD. And I can tell you that the Mortgage Bankers Association and a number of lenders are working to change that. But the other thing is HUD's reserve requirements. So HUD has a much more robust capital needs assessment process than you see on Fannie and Freddie. And sometimes an older asset that maybe hasn't undergone a renovation recently might have higher ongoing reserve requirements because HUD looks at a more prescriptive useful life analysis for components and analyzes more components. But that said, a B or C asset that has just undergone a repositioning where maybe units have been upgraded with new finishes, appliances, cabinets, countertops, maybe you've got some newer HVAC equipment, you've redone your parking lot. Those types of properties, the capital needs assessment looks at those improvements as having been made and therefore starts the useful life over. And so newly renovated BC assets, I think, are a good fit for the HUD program. Additionally, HUD will look at a scope of work. So if you've got a property that maybe you haven't done a bridge or you did an acquisition bridge and now you're looking to do a value add, HUD can escrow for proposed improvements and consider those improvements to be done for purposes of the capital needs assessment. So we can build some of those into the transaction and underwrite as if those improvements are completed. So I think that's important to note as well. But you're right, the newer properties do tend to size a little better from a reserve standpoint on the HUD execution.
Okay, so you're going to look at, I know on Fannie and Freddie you do like a 10-year maybe reserve table or so, and then on HUD you're doing what, on a 30-year? I don't know, what do you guys do on HUD typically?
It's a 20-year analysis with a focus on the first 10 years for minimum balances. The main difference is where your Fannie or Freddie PCNA might look at just your big ticket items, your HUD PCNA is going to get a bit more granular in terms of the components. That being said, your replacement reserve can be used for any of the components in the property. So a more fully funded replacement reserve is there for the use of the owner as well. So depending on the goals, I think, of the ownership group, having a more fully funded reserve may not necessarily be a drawback.
Right. So the translation of all that is your replacement reserve that you typically underwrite, let's say on a Fannie Freddie, might be $250 to $300 a door. On the HUD, it might be double, right? So you might have a $600 per unit replacement reserve or a little bit higher. The one thing that I did want to ask you about also is, some people are, there's a lot of interest rate forecasts. Some people are saying it's going to 7%. Some people say it's going to 3%. Nobody knows. But for HUD, someone might say, well, the interest rate's high right now. And is there a way to lower my interest rate potentially in the future? So I've heard rumblings of this, but maybe Mr. W or Mike try to explain that process, because I think if someone locks in at 5.5, they're like, well, I'm stuck now. I only got 5.5. I got to step down prepay. Can never get out of this deal. And if it drops to 3, like it did during COVID, I want to be able to refi. So does HUD have a process for that, and sort of give us the scoop on that?
Sure, I'll take this one, and then Mike, I can throw it over to you. But yes, HUD has a program called the mortgage modification process, where you're able to reduce your interest rate without having to pay a prepayment penalty. Process takes maybe 45 to 60 days and only costs $5,000 to $20,000. And so we are seeing a lot of this for the same reasons you mentioned, James, with people concerned about going, doing a 10-year fixed, agency loan with a bunch of yield maintenance. It'd be really expensive if rates drop to try to refinance and take advantage of the low rate. Where in this instance, HUD does have a built-in backstop to be able to reduce your interest rate without having a really large prepayment penalty. Mike, anything to add on your end?
No, and I would say that's a very simple process and very, very highly utilized when rates go down. So in 2020 and 2021, many lenders modified a good majority of loans that were in their books. If you think about where rates were at the end of 2018, a lot of those loans were locked in the high 4s as well. And those loans were all able to modify in 20 or 21 and reduce those interest rates. So you're really locking today the upper bound. If you were to lock a HUD rate today, you're locking the upper bound of your interest rate over the period.
So I think that's an important piece to kind of talk about too, is if we got to change the narrative a little bit. For the last number of years, Fannie Mae and Freddie Mac loans have almost been like bridge loans. And people took a fixed rate, and after a period of 1 or 2 or 3 years, when they hit their number, they sold, and they had this huge yield maintenance penalty. And a lot of people said, I don't want to pay that yield maintenance penalty anymore. And so they went over to bridge loans, not believing or not knowing or not feeling that that interest rate was going to go up when the SOFR or LIBOR went up. And so they almost got stuck in a position that interest rates went up. And now, values have maybe come down significantly in some of these properties. And again, the reason why we're talking about HUD is really to protect the limited partners. So if you are in a partnership that is not talking about trying to do a HUD transaction, I think you may be missing out. Because if your group cannot raise enough money, because, I think Neil Bawa was saying, which I tend to agree with them, is that if there's a capital call out there right now, is that you're not getting 100% of limited partners coming together and pushing money into the partnership to either buy a new interest rate cap or decide what they're going to do if they want to do a refinance with Fannie Mae. So HUD may be the best execution for you to do. So you should be talking with your general partners, or the general partners should be talking with you about all these different options to just keep this property going. So Fritz, let's talk about a real life example, because I want to, have people know in their heads of what that really means. Can you give me an example of somebody that wanted to refinance and it was going to cost them X amount of dollars of a cash in versus somebody else? Okay.
Yeah, no, just recently with a repeat sponsor of ours and Old Capitals, we sized an agency loan for a takeout, and I think their current balance between their current mortgages were maybe in the $45 million range, something like that. And I think on the agency side, on Fannie and Freddie, we were somewhere in the $38 to $40 million range. This is a Class A asset, and when we sized it on the HUD side, we were able to get 47-ish. Almost 50 million. So they were able to not having to put any cash in. So they went from, if you did an agency loan of, $5 or $6 million cash in, to almost a cash neutral or slightly cash out outcome. So that's a real life example of what we're seeing today. And really for the same reasons we talked about, they're able to kind of lock in the upper bound of their interest rates going forward. And if rates do come down, you can do a mortgage modification at a later point and lower your interest rate at that point.
So that's an important point, is that, again, if they were looking to see if they could have flexibility with Fannie Mae and Freddie Mac, and they'd actually have to do a cash in refinance to just get out of a bridge loan. And so they had a big $1 million interest rate cap cost coming to them shortly. And so they didn't want to pay the $1 million or so. Now they had it, but they didn't want to pay it. And they knew that they were going to keep this property for a longer period of time. They wanted to keep it as a legacy asset. So again, it's really changing the narrative in some of these investors' minds. If you're a general partner or if you're a limited partner, just think about holding this asset longer at this period of time to really survive to 25 is what we're telling people to do. That the HUD execution is a much better way of doing it. In this case, they were able to get some cash out, but really put the loan out for a longer term. And that's really what these folks want to do, because again, they could have spent the money, but they also want to refinance. And again, if they were to get a 5% rate or 4.7, whatever that number comes out to be when they eventually lock this loan, which will probably be in about 3 months or so, is that if the interest rates go down, like James has said, if they do that, then they can exchange one higher cost interest rate for a lower cost interest rate, and it costs them $20,000 or $25,000, which is really nothing. It's not a refinance. But again, the other downside is that there's really no cash out in the future. So you're setting it to forget it in the futures. So HUD is really for a legacy asset. I'm not talking about for everything, but for maybe future deals. But right now, on the deals that you may have that you own currently right now, and if you're thinking about refinancing, I would look at a HUD execution as one of the benefits that you can do to kind of avoid a large cash in piece. Mike, any further comments on that?
No, I think you've really summed that up well, and it's a great program for a long-term hold. It really is, and that's what we've been seeing a lot of. Historically, long-term holds have been really a key HUD borrower and key users of the program. But at the same time, we are seeing more assumptions as well through the HUD program than we ever have before. It is a fairly easy process. It's a low fee process, and if you're locking in favorable interest rates, and even if you are to modify, and if you lock today and rates go down and you modified in a couple of years, and then you did want to sell, that TPA process is out there as well. But what I always try to do is sort of alleviate some of the misconceptions about the process. While it is a little bit longer and a little bit more paperwork than a Fannie or Freddie execution, working with an experienced lender will help you, make that process a lot easier, help you with the paperwork, and really, letting folks know that the 223F is really a 4 to 6 month process with a lot more predictability in it, I think is, a real selling point of the HUD program.
James, anything more to add to that?
The only thing I was going to add was I know it's probably different borrower scope, but talk about sort of the requirements from the borrower side on the 221D4, and then talk about 223F, because I mean, on just your standard Fannie Freddie, you might need net worth equal to the loan amount, and then 10% post-close liquidity. How do they look at the borrower on the construction side and then the 223F?
Sure. So I'll start from a net worth and liquidity requirement. HUD's guidelines are a little less firm than Fannie Freddie's are, but I would say they're roughly similar. HUD wants to make sure that you have sufficient net worth and liquidity. But what HUD's real focus is experience. And on the new construction side, most importantly, I'll start. HUD always likes to see somebody who has positive previous HUD experience. But knowing that you have to do your first deal to get previous HUD experience, HUD wants to see experience with a project of a similar size and scope. So if you've historically built duplexes and you want to build a 200 unit complex, HUD might encourage you to bring in a sponsor with experience building a 200 unit complex. But if you're doing something that you've done before and have a positive track record on the new construction side, HUD will give you credit for that. HUD does look also at the other members of the development team. So they want to see that you've got a strong management agent, preferably with HUD experience. And a lot of the big management companies that you see and your folks are typically working with will have that experience. Also, if you're looking to do a new construction project, making sure that you hire a strong architect and a strong general contractor will go a long way, and your lender can provide some recommendations on both. But I think as you're out there vetting team members, asking if they've done a HUD deal before, asking your contractor if they're familiar with Davis-Bacon, making sure that your architect understands the need for a full set of plans and specs. HUD doesn't really have any additional requirements to the plans and specs on top of what you might do otherwise, aside from not allowing design build, but just making sure that your architect is able to do that and hopefully has done a HUD transaction in the past will help. On the 223F side, HUD again looks mostly for your previous experience and successful operation of multifamily properties. And that's mitigated or on top of that, HUD looks again for a strong management agent. But really, the operations of the project under your ownership and your experience are really what sell the deal at the end of the day. It's non-recourse lending, and HUD wants to see that the financial capacity is there in the ownership group to fund shortfalls and support the property, but they aren't. It is not a recourse loan, so HUD is more looking at the operations of the property and the experience of the ownership and management.
All right, let's wrap this up. We'll go around the table for final words. Fritz, what should people know about what's going on?
I would say just generally the HUD process sometimes gets a bad rap. I think some people had some horror stories in terms of timing and paperwork. And I think over the last, for sure since COVID in 2020, the process with HUD has gotten a lot more streamlined, a lot less, actual paperwork. The closing process is a lot more smooth. And so I would recommend people to take a look and give it a shot, because I do think that the program has gotten sufficiently better in the last 12 to 24 months.
Mike, final words?
Yeah, I would encourage, just like Mr. W said, to take a look, evaluate a HUD quote side by side, talk to a lender, talk to go through the pros and cons of an agency execution versus an FHA execution, and take a look at the numbers, look at the timeline, because it might be a right fit for you and something that you just haven't thought of. And I think it's really worth exploring in this market.
All right, James, we come to you, the professor, for
Yeah, the past couple of years, everyone's been spoiled. Everyone's made so much money that they don't know what to do with it. Been complaining that, oh man, I had this prepayment penalty. I could have made, double what I thought I was going to make. Now it's a new narrative, right? So now it's go back to rule number one, don't lose money. So if you want to be in this game a little bit longer than the last couple of years, and you want to be in this for 5, 10, 15 years, you're going to have to do something to protect your capital. And so you're going to have to put in more money on a Fannie Freddie deal, or you're going to have to potentially do a HUD loan. So I think we covered a lot of stuff today, but definitely just reach out if you have any questions on the HUD process. We'll get it sized up and let you know where you stand.
Yeah, absolutely. I think the HUD is the protection that you may need to get these loans closed. So maybe in the future, you don't have a problem, whether it's a capital call that you're going to need, or you're going to have any issues in the future. So talk to your old capital reps to see if they can help you. Again, we don't want to see anybody lose any money. Just set the narrative to maybe a longer narrative, being 35 years, and let's get going on that. So again, Mr. W, thank you very much. Mike, appreciate it. James, always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.